Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm your host, Michael Becker. Today, I'm excited to have my longtime friend, James Eng, on with me. James, thanks for coming on today.
Thanks for having me, Mike.
Yeah, so James is the National Director at Old Capital Lending. I've known James many years now, and actually ended up going to Oktoberfest with him in 2019, so we've known each other a long time. So James, maybe talk a little bit about your background. Tell us, maybe starting off, what is Old Capital? What do you do for day-to-day?
Yeah, so Old Capital is a mortgage broker based here in Dallas. We have about 10 directors all throughout the nation. And so we do about $1 billion in multifamily a year as an intermediary, right? So we work with the investor to really find the best debt for their deal based on their experience and sort of the property's track record. So I actually started at GE Capital as a sort of in their commercial finance program, sort of as sort of a mini CFO of all these different businesses. And then came here to Dallas and really started working with their commercial real estate group as a loan underwriter. And I did that for 10 years.
Okay.
And really what I learned there was that guys who own commercial real estate have a lot better balance sheet than doctors and attorneys and lawyers. And so when I was sitting there underwriting all these loans on office buildings like we're sitting in right now, the guys who own these properties were just killing it. And so I started looking at getting into multifamily. And the reason I started looking at multifamily really was, 2008, 2009, we started taking back a lot of properties at GE as the lender. And so the two properties that we really didn't take back were multifamily and self-storage. So I was like, I got to figure out this multifamily thing. And so in 2013, 2014, I just reached out to you, and you were one of the first people that sort of responded and was like, hey, let's go get lunch or whatever. And then we went and got lunch, and that was sort of the beginning. And that's, I met Paul and then really started into Old Capital then.
Yeah, I know James actually asked me to hire him, and it was probably a mistake I didn't hire him. I got him introduced to Paul, and you've done really well for yourself. So you've been, in Texas your entire life. You grew up in Houston, right? You went to UT?
UT, yeah, went to UT for finance there, and then spent 10 years at GE, and now I've been at Old Capital since 2015. And so, really been doing, close to $1 billion in loans since 2015. So we don't do big loans. We do, our loans are, 5 to 15 million. So it's a lot of loans.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
Back at GE, you weren't loaning too much on multifamily. Was it predominantly more like on office and retail and things like that?
Yeah, so GE had two programs. One was a bridge program, so on our balance sheet, bridge program, 3 to 5 years, and then also CMBS. And so we did office, industrial, retail, but what happened is we didn't do a lot of multifamily because the agencies were so competitive in that space on stabilized product. And so the bridge loans that we did on multifamily were deals like Campus Estates. So you just had John Griggs on.
Yeah.
So he bought Campus Estates.
Okay.
That whole area near Oracle in Austin.
Yeah.
So we did deals like that. So they were sort of like student housing or lease up plays, deals that just weren't stabilized that went to Fannie Freddie. So a little bit of multi, but a lot of office, industrial, retail, self-storage.
So what was that lending environment like? A lot of people that are in this business now started, around 14, 15, or maybe even younger than that, because our industry's really grown quite a bit over the last, decade. What was the lending environment like back, say, in 2005, 2006, when you're making some of those loans, and how is that different from what we're seeing today?
2005, 2006, 2007, I still remember doing bridge loans, doing CMBS loans, and essentially, we just got deals done. It didn't matter. And But what was funny, in 2008, it just shut off. And so a lot of the deals that we were doing on our balance sheet, we could keep doing those. But once CMBS shuts off,
Yeah.
it just shuts off completely. So 2008 to really 2011, we didn't do any loans on
Yeah.
CMBS. So we could do balance sheet loans, but no CMBS.
Yeah.
And so that, I think, just speaks to the overall market, that there really wasn't any lending available. And so I think that pretty much shut down pretty much all office, industrial, retail. But there was probably a small amount of multifamily that you could do, but it was probably low leverage at that point.
Yeah, no, it was. I was a banker at the time too, working at Wells Fargo. I was a regional bank, and then Wells Fargo bought my bank in '08, and it was one day everything was good, and then boom, it was just off overnight, and it became really, really challenging. And the first thing that really came back was the multifamily lending. That was really kind of the first thing, and it's really where I cut a lot of my teeth, is just doing deal after deal after deal, fixing a lot of these broken properties, and doing the bridge loan, and so they can get into a Fannie Mae or agency debt. So Old Capital has been around a long time. It started by our mutual friend Paul Peoples, and like I said, you've been there for, I guess, 6 years now.
6 years,
yeah, it's been a long time now. So what you guys really do well is you really specialize on kind of like two types of clients, from my observation. Either I'm newer in the business or I'm new into town, and you guys really do a lot of business. You have multiple offices, so maybe talk a little bit about the offices that you guys have, and then maybe we could kind of get into a little bit more specifics about the clients you guys work with.
Yeah, so in terms of offices, we opened an office in Atlanta last year, and then we have essentially 4 or 5 guys here in Dallas, and 1 in Austin, 1 in Houston, and then we're looking to grow out in Phoenix, and then we have 2 directors in California. And so majority of the time, a lot of our business we're doing in Texas right now, just because investors are looking to come to town and buy here. And so a lot of our guys are local, but a lot of them come in from New York or California. We had lunch with a guy from New York yesterday, and essentially they're like, look, we own pretty much in the Southeast and Southwest, but we don't own anything in Texas, and we want to be here for the next 5 years. Help us buy deals. And when they're going on tours with listing brokers, they really have no credibility of closing anything in this market. They can't point to anything that the listing broker is familiar with. And so we come along, go on the tour with them, and really give them that associated credibility of, look, they're going to work with Old Capital, they're going to figure out the debt, they're going to vet them for equity, and so that they know this guy can close.
Yeah, that's really what I think you guys have really carved a great niche out for, is like, I'm either new into the business, I'm a engineer, I'm a doctor, maybe I have a little bit of a balance sheet, but everyone's got money nowadays, seemingly, that are looking at multifamily. So how do you get that associated credibility or certainty of execution goes up quite a bit in the broker's mind if you guys are involved? Or if I know a lot of times, like some of these brokers, the listing agents, when they get these random phone calls from New York or California and you want to come into Texas, they don't know if they should spend time with that client or not spend time with that client. They'll kick it over to, say, you at Old Capital. You guys vet them out. You spend a bunch of time kind of seeing if they're worth spending time on, and if you guys are willing to work with them. I think that then tells the listing agent to take that client a little bit more seriously. So I think that's probably a lot of where you get your business from.
Yeah, especially getting out there with them, touring properties, and then also just educating them on the market. Like, we might drive around in the car for 2 hours and say, all right, look, we're going down 183. This is South Irving. This is North Irving. This is the difference, who the major employers are. These are pockets that maybe you don't want to be in for your first deal. And sort of figure that out up front and just educate them on the market, but then also making sure that when they're with the listing broker, they're talking the right talk, right? And so getting them educated up to that level, right? If you're coming in as an engineer, as a doctor, sort of setting that foundation. Like, a lot of people have listened to the podcast and they'll reach out and they have maybe bits and pieces, but a lot of times we'll sit down, get a piece of paper out, and really draw out the whole puzzle for them and sort of give them examples of deal stories that we've put together for people. And I think that's helped a lot.
So if I'm coming from California and, I sold a 10-unit deal in Los Angeles, I want to come buy, a 100-unit deal in Texas or whatever the math's going to be. What's the way for them to get your attention? I mean, they're just going to cold call you. What are the things that you're going to ask for them to provide to you to know if they're credible or not credible or able to be bankable, really?
Yeah, so a lot of the people out of California, like on that 10 unit, they've done like a local recourse bank loan. Now they sell that deal, they've got $2 million and they're bringing it here.
Right.
And so a lot of times we'll ask for just, personal financial statement. We'll ask for their resume, if they're going to buy the deal on their own, or are they going to syndicate the deal, and really just get their background and what they want to buy. And so once we start figuring out their box of the deal, they come into town. We'll usually set up, a 15-minute meeting with them to really go through it, or just nowadays, no one's flying in. A lot of people are just on Zoom. So we'll set up like a 15, 20-minute Zoom call after they've sent us a personal financial statement. Maybe they've read our white paper or gone through some of the stuff on YouTube that we have up there.
Sure.
And they should have an idea of sort of what they qualify for, but we sort of hone in on that from them.
Yeah. And then if that group from New York, for example, so they've owned multiple, thousands and thousands of units across the country. So the benefit that you really bring is just the credibility that they can actually get these deals done. And then maybe the introduction to some of these brokers that they don't know firsthand.
Right.
And that really kind of shortcuts it for them.
Yeah, because I mean, in every market, like you walk into Phoenix or you walk into Atlanta, there's 10, 15 listing brokers who really control 80% of the deals, 90% of the deals. And so having that relationship where, similar to you, like we've closed thousands of these loans, and the lenders wire funds and the broker gets paid, and that's when you close. And so usually it's not like right now, equity is not the problem, right? In terms of all these guys have a ton of money to put to work. It's really just finding the deal and winning it, right? And so going on the initial tour, getting on the phone maybe on a best and final call with the seller, and saying, look, we vetted this guy, he can qualify Fannie, Freddie, or Bridge, or whatever we're doing on that deal, and just helping them win the transaction.
So maybe we talk a little bit about that, kind of the different debt options. So you guys are a mortgage broker. You probably do 95% of your debt is in the multifamily space. You do a little bit of office, a little bit of industrial retail, but it's really you're experts in the multifamily space. Maybe talk a little bit, if I don't know, I'm sure most people watching this probably know, but maybe talk about the different types of debt options that are out there and some of the benefits, and maybe compare and contrast those a little bit.
Okay, yeah, I like to think of it as sort of like, if you start on sort of the far left side, sort of like your recourse bank loan, like what you were doing at Wells Fargo, just like guy coming in, doesn't maybe have as much experience, but he's got secondary source of income. He still is a doctor, attorney, lawyer. So start on that side, on the recourse bank side. That's going to be shorter term loans, bridge loans at maybe 75%. Okay. And then as you get more and more experience, you maybe move over to Fannie Mae, Freddie Mac. And then that's going to be your non-recourse up to 80% on stabilized deals. So, in the last 12 months, Fannie and Freddie has probably controlled, 80% of the market. Like they've just been very competitive in that space. And then on the far right is really just sort of your non-recourse bridge. So if it doesn't sort of fit in Fannie Freddie's box, you can go with a bridge, and that's what we did at GE. And that's usually for $5 million deals and higher in terms of loan amount. So those are really the buckets. In terms of pros and cons, just that first one, like deals at Wells Fargo, that first one is recourse, so you're signing personally. Everything else is going to be non-recourse. And so a lot of people automatically assume that it's 5 units or higher, and I should get non-recourse. It's like, no, that's not really how it works. So
let's talk, maybe drill in. You got your 2 different bridge loans, like the type I used to be a lender on a balance sheet at a local or regional bank that you're going to make you sign joint and several guarantee on the full loan balance. So you have a $10 million loan, you have $10 million in recourse. So if something goes wrong, they can sue you and try to collect the money. Then you got your non-recourse bridge option over here. Why wouldn't I automatically just go do a non-recourse bridge when, because that's better on the surface. So why would you choose a recourse loan over a non-recourse loan?
Usually, number one, the size amount. So most of these non-recourse bridge lenders, they want the loan really to be $5 million and above. Okay. And so most people coming in doing their first deal, they're buying 20 units in Arlington. They're not getting a $5 million.
So have $1 million or $2 million loan.
It's a smaller loan amount, and then sometimes it's just timing. Like you got to get a deal done in 25 days, and a lot of these recourse bank lenders we've closed. People have called us and said, "Look, Freddie just declined this loan. I'm hard $200,000.
Right. Help.
I got to close, right? I'm sure you've gotten those calls.
Yeah.
And so, the recourse bank lender can come in, close the deal, get everyone to sign, and get the deal done. So, but with both of those options, the reason people even do bridge is really because, they have an easy exit, right? So it's either no prepay or maybe a 1% prepay on these loans. And so it gives you that flexibility to get out of these loans if you've done the rehab or you just want to sell it.
And some of the other things when you see, which was really prevalent up until about a year ago when the COVID lockdowns really started happening, you had a lot of these debt funds where they would just go out and have a line of credit, essentially, where the warehouse line, where they would go make these loans and then leverage up their, they borrow money at 3 or 4% and loan it out at 5 or 6% and make a spread on it. But with those loans, they had, a lot of gotchas in the loan documents. It was non-recourse. There's a lot of gotchas in loan documents. They would have these lockbox where they could capture all your money, and it's almost kind of like a loan-to-own type product. So they're kind of looking in a lot of ways, or at least it seemed to me, almost slightly predatory, where they're like, the first hiccup they're going to come in, put you in default, put default interest on you, and then start putting the pressure on you, and then if you can't do it, they'll just take the asset back at 80 cents on the dollar because they made you 80%
they made you 85% loan, right? And so we did see some of that. And so right now I would say pre-COVID, let's say 2019, there was maybe 20 bridge lenders that could do a $15-20 million deal. And then March hits and it went to zero in terms of any bridge lenders out there. And then I would say probably third quarter, fourth quarter last year, those people slowly started coming to the market. So we probably got 4 or 5 reputable bridge lenders in the market right now who could still do 75% loan to cost on a deal.
But you're seeing more recourse debt right now than you probably did next to zero on a very small percentage. Your loans in 2019 were probably recourse loans, and that elevated quite a bit as we're in first quarter of 2021 now.
Yeah, so a lot of people, especially if they're buying deals, it's their first deal, they'll maybe just do a recourse bank loan because Fannie and Freddie, they've actually sort of tightened up on the experience piece. And so they were wanting to see sometimes 2 years worth of experience before giving the keys to somebody. So before, with 2019, it was sort of like, all right, I hired a third-party property manager, and that was enough.
And that would be with the small balance program for both Fannie and Freddie?
Yeah, so small balance. So if you're buying like a 50-unit deal, 60-unit deal, and it's a $5 million loan, you could go get a Freddie Mac small balance loan and plug in a third-party property manager, and that was fine. But they're wanting now to see some ownership experience. And now the second piece of that is now they want to see, how are your properties doing sort of post-COVID? Right? Let's see the schedule. Like the schedule of real estate was sort of like a check the box before. Now it's like they're digging in to every number, every deal that's under 125 or over 75% LTV. They want to know the story.
Okay, and then let's talk, maybe that's the small balance, but on kind of the regular DUS program for Fannie or the kind of the non-small balance Freddie Mac, kind of your traditional loan. What's really changed? Like what's today's appetite now that we're kind of in 2021? I know they announced the caps, and then they raised the caps. So I think Fannie and Freddie each have 85 billion.
80 billion,
80 billion
this year,
to place out this year, which should be similar pace to what they put out in say 19 and 20 as well. What's that like? Because my experience is from being a sponsored operator and just getting loans quoted kind of through our daily course of business. It seems like they're not being extremely aggressive right now on pricing, unless you have the affordability component. So what is that market like right now as we're in Q1 2021?
Yeah, I mean, they definitely increased their spreads probably about 20, 30 basis points from last year just off the bat because they were doing 80% of the business.
Right.
And, a lot of people are asking us about reserves. So, you're putting up 12 months or 9 months of P&I right now on
for the COVID reserves.
For the COVID reserves. Yeah. And people are asking like, when is that going to go away? And it's like, well, right now your Fannie Freddie all in, you're probably 3.25 on rate, and nobody else is close. Right. And so they're saying, well, we have all this business. People are putting up 12 months of P&I. Like, we're just going to keep doing that until our allocation, our percentage of multifamily goes down, really. And so until other lenders really come into the market to be competitive, they're going to keep them there to me. But to me, we're still seeing plenty of deals go Fannie, Freddie. A lot of people, similar on have taken sort of fixed rate debt. They're looking more at floating rate debt.
Yeah.
But I think the biggest thing probably is that Freddie conventional is a little bit more conservative on underwriting. They're
Right.
going to take higher taxes. They're going to take higher insurance, and their underwriting is been stricter.
Right.
And you have to sort of take that up all the way up to Freddie versus just at the DUS lending
And
side.
when did that kind of flip? Because I know obviously there was stuff up to the first quarter of last year.
Yep.
Then there was very little, and then it started kind of turning on with the COVID escrows. But to me, we did a few loans the second half of 2020, and it didn't seem like their underwriting standards were too strict. But then now all of a sudden, kind of turned the calendar in 2021. They're really stressing a lot of these metrics a little bit harder.
Yeah, I would say Q4 last year is when they just had sort of a flood of people saying, all right, yep, I want to do a Freddie conventional loan like Mike Becker at 80% with 5 years IO and, a 200 over LIBOR spread or 200 over SOFR spread. And they just kept bumping up the spreads. And then I think what we saw was that people with maybe like one, maybe two deals of experience, and then a B minus C quality asset, and like Freddie wants to do affordable, but they don't want to do that many affordable deals.
Sure.
And so I think as that, they sort of increase the spread and increase the borrower experience side as well. And so what like my chief risk officer at GE, she never declined a deal. She always just said, well, if you underwrite taxes at 100% and we get this covenant and that covenant, we'll do the deal. But then it was always so heavy on the credit side that basically the guy would leave, right? He wouldn't take the deal. So that's what Freddie has started doing, is saying, well, we're going to underwrite higher taxes, and then we're going to drill down into your expenses. And I've seen them, I don't know on your deals if they've sort of said, all right, show me your portfolio. Show me what you're running payroll at, R&M at, across your entire portfolio. And then that's what we're going to use on the underwriting.
Well, we're fortunate from the standpoint we have deals in two markets, and we have a lot of deals in the two markets that we're in. So we have a lot of relevant expense comps, but that's certainly something that they're going to say, okay, you're buying a 2005 vintage deal in North Fort Worth, and I own a couple of deals a few miles away. What's your payroll on the 2003 vintage deal, 3 miles away? And that's a very relevant direct comp, because if they don't have that, they're going to go to the appraiser, and then the appraiser has to get his expense comps.
Right.
And kind of work through that. Same thing with taxes, insurance, kind of insurance. There's not a whole lot to it, but we can underwrite kind of portfolio average to our repairs and maintenance and advertising and admin. So if we're going in and the appraiser is a little higher, or the historical financial statement's a little higher in R&M, I can say, hey, I own 5 deals that look just like this, and our average is $300 a unit, and
plug that in.
Drop it from 350 to 300, and then that just pushes your loan proceeds up.
So that becomes harder, right? If you do not have expense comps in your own portfolio. So sometimes we've asked management companies to help us out on that and just sort of use their overall average for that submarket. But it's just questions like that have come up in Freddie conventional underwriting.
So that's great. What I think a lot of people learn from like deal stories. So I don't know. I don't want to put you on the spot a little bit, but is there any like recent deal stories or something along the way that might make a good encapsulation of kind of what a typical deal that you guys do? What does that kind of look like? I know maybe a good example is I know that we have a client, your client of yours, purchased 4 or 5 deals from me, and I know that he's done several kind of on a loan assumption. So maybe you talk one, what does a loan assumption route look like? And then I know he bought a property for us at Grapevine that was new debt. Maybe you kind of compare and contrast with him. What's the difference between kind of going the new debt versus loan assumption, and what's the typical kind of the abbreviated version from the beginning to end? What does the process look like if I'm kind of newer to this?
Okay, yeah. On a loan assumption, the biggest thing is really sort of figuring out what the prepay is for the seller, and then you're usually getting that discount on it, and you're gonna have to work with that specific Fannie Mae lender, right? So whoever put on the seller's loan, that's who you're gonna work with.
And what is the DUS lender looking for if they're gonna go from Michael Becker as the owner to the new owner? What are they checking the box from experience and things like that? What does that look like?
So I feel like that's very lender dependent.
Okay.
And some lenders, they're gonna hold to that standard. I've seen where they've worked with guys who they might only have 2 or 3 deals, and they would qualify Fannie Mae on a new deal. And so they're sort of a little bit lighter, a little bit more lenient on that. And we've helped people. We probably did 4 or 5 assumptions last year.
Okay.
And, on one deal here in Garland, basically, they went in, the lender said, all right, we can get you maybe like a $2 million supplemental. They started in underwriting, and basically collections fall off a little bit, taxes come in a little higher. And then they said, well, no, it's 0 on your supplemental now. So just go out
Could
and
assume
raise.
the mortgage, but
Now
no.
assume the mortgage, no supplemental.
Yeah.
And so, that's when we get the call usually.
Sure.
It's like, James, we're looking at this deal, and we had a supplemental, now we don't have a supplemental.
Sure.
And can you figure that out? And so what we did, we went in, we sort of re-looked at the lender's underwriting, the appraiser's underwriting. We sort of gave them some expense comps. We sort of moved some stuff around. Collections popped up for 1 month. And then we had everything perfect. And then it was like March 15th.
Yeah.
And we were like, and Fannie basically said, guys, we can't close this loan.
Yeah.
And we're like, what are you talking about? And they're like, we're about to come out with language on COVID reserves. So they ended up doing the deal, and it was sort of a modified, they didn't even have the language yet.
Sure.
But they ended up putting like 6 months COVID reserves up, and then we got the deal closed. But that supplemental went from 2 million to 0 back to like 1.5.
Okay.
And so sometimes it's just having someone in there who knows all the tweaks
Sure.
on the underwriting and then has some deal experience in that market.
Yeah.
So I would say on assumptions, just make sure, going in, sort of what you got on the assumption, because you're going to get that loan amount.
Right.
But then that supplemental piece is probably the wild card. We haven't seen a lot of supplementals sort of post-COVID because you're having to put reserves up on the entire loan amount.
Sure.
And so that.
But if you just do a straight assumption, they're not
straight
making
assumption,
you
no reserves.
Yeah.
Yeah. So that's most people are doing straight assumptions. They'll wait 12 months and then do a supplemental at that point.
Right.
In terms of new debt, I mean, what we're seeing is really 2 things. One is people are looking at the Freddie conventional floating rate program, just with interest rates where they are now, and just sort of buying caps on them. So that's worked really well. But if Freddie is over aggressive on expenses and just can't get there, or Freddie conventional really, I'm not going to say they don't like non-U.S. citizens,
Right.
but it's just very onerous, right? So you have to put up more liquidity, and you have to show more liquidity at close, which
Right.
people might not have.
Okay.
And so, so whether it's non-U.S. citizens or maybe you have a tenant in common structure, Freddie conventional might not have as much flexibility.
Right.
And so we've been using still Fannie conventional a lot.
Right.
And we've just taken in the yield maintenance. So we'll do like a 10-year, 7-year yield maintenance, or a 10-year with a step down.
Right.
And we're just paying for it in the interest rate.
What's the adder typically to the spread if you either go from 10 to 7 on the yield maintenance, or if you do the step down? What step down options do you have?
Usually it's just straight, like on a 10, it'll be like 5.5, 4.4, 3.3, something like that.
Okay.
And then so usually from like a 10.9.5 to a 10.7 might be 15 basis points, and then it'll be another 15 to 20 on top of that to go to step down.
Okay.
And so depending on people's business plan, how long they plan to hold it, that's going to drive what they can take. And
Sure.
some deals that can cover well, they'll just do the step down because it really isn't affecting their loan proceeds.
Yeah. Okay. That's good to know that they have that flexibility, because I know I've been stuck a few times.
You've done a couple of yield maintenance deals in your time.
I've regretted at the end of the day. So that Freddie floater has really been very attractive. We've done, I don't know, a bunch of them. So it's been a really good execution for us. So maybe kind of pivoting a little bit. I know a lot of the people that you work with. We talked about a lot of people like kind of out of town, but I'm new to this. I know a lot of the investment clubs. You guys help a lot of the newer sponsors, newer groups kind of coming into it. If I'm a new sponsor coming together, what are some of the things that I need to think about, especially as it relates to like the debt? I know there's equity, there's debt, and then getting the deals that you kind of, when you're doing a transaction, I think of it like a puzzle. You got a lot of puzzle pieces. You got to kind of put them together, and if you fit them just right, the picture comes clear. You can do the deal. You work with a lot of like newer or first time sponsors. What are some of the challenges that they face, and some of the things that you guys could help them kind of overcome?
Yeah, I mean, a new guy walking in the door, he essentially has his balance sheet. That's really it. And so what we try to do is really have them put together, I would say, 4 things. Net worth and liquidity. So that's their personal financial statement. It's the multifamily experience. That's the second thing. Third is who's going to raise the equity, or how you're going to put together the equity.
Sure.
And then fourth is really just getting out there, finding a deal. And so of those four things, you got to figure out what you have, right? So at the beginning, you have one thing. You have your balance sheet. That's it. And if you don't have your balance sheet, then you need to find someone else with the balance sheet. So really, we're looking for 4 people to put together on a team.
Okay.
And that's the only way you're really going to qualify for the loan. And so when you're out there talking with people, like in 2014, when I came to you and sort of asked you about this business, sort of, all the coffee meetings, all the Zoom meetings, you have to figure out sort of what that person could possibly bring to your team and start putting that together. And so that's what we help a lot with, is that, we do larger conferences, we do larger speaker series events. And so like in a lot of these networking meetings, we've got, all right, this guy's got net worth and liquidity, this guy has experience, let's put those 2 people together, let them connect, and then they can actually go out and buy a deal now.
Yeah. So that's great. What are some of the mistakes, or what are some the clients of yours that are the better clients, that are more successful clients, put it that way? What are the things that they do when they work with you, and then the opposite of that? What are some of the people that are less successful, or some of the little bombs you got to go kind of fix along the way? Maybe give some comments around that.
What's funny is, I'm sure you've talked about this a little bit, is just that like the brokers, let's say listing brokers, the mortgage brokers, the guys in this industry who are like gonna feed you deals and get you connected with people, those are the last people you should try to shortchange in paying.
Right.
Like that is the worst business model out there.
Yeah.
And so some people will come in and they'll just be like, all right, yeah, like your interest rate is like 5 basis points higher, or your fee is 5 basis points too high, or whatever.
Sure.
Right. And I'm like, well, you can either pay us the same that you're going to pay everybody else, or pay us less. So I would say the people in this business who do really well, they almost like overpay their brokers and their lenders and things like that to make sure they get access to deals.
Right.
And so I think that's probably one thing where we've had to tell, like some of the people who come into this business are like, all right, they're thinking more like a single family mindset. Where they're just like, all right, I'm closing on this house and I just need the closing costs to be as low as possible.
Right.
So I'm just gonna, talk everybody down and grind them down to the lowest possible fee.
Right.
But then what happens is you don't see the next deal.
Right.
Or they don't bring you that next deal when something falls out. Like you're not the first call.
Sure.
And so the people who have done really well, they remember the people who have gotten them to that spot.
Yeah.
And so, like some people will call me and essentially, I helped them on a deal like 2 years ago. They'll call me and say, look, I'm looking at this deal, and I can sort of connect them to all the people. I can connect them maybe to the seller, the listing broker, other properties in the area. So there's all these pieces that like you can't see.
Sure.
That having those relationships is super important.
Yeah, no, relationships. I mean, it's a relationship business. It's a completely unfair business. It's who you know, what chips you can trade. And if you're newer in town or newer in the business, having that associated credibility is certainly key to kind of overcome all the unfairness in this business, really. And that's something I think you guys have done a great job with. Any advice? I know you were looking to, you weren't necessarily young in the business, but you were turning in multifamily. You came to me, we talked, and had some advice I gave you at the time. If I'm right out of college, I'm trying to get into this business, any advice to someone that's starting out? What were some of the things that you did early in your career that kind of led you to the success that you have today?
Like, to me, I think people have to figure out, like, there's so many parts of this business, right? So like Ken McElroy, he started in property management. Like both of us started more on the finance side.
Sure.
You have to figure out sort of what your skill set is, because you have to almost have like that one superpower that you're deep in.
Sure.
And then you can sort of fill in the other stuff. And so my recommendation to a lot of people is like find somewhere in the business that you can work if this is something you want to do. And the one thing that probably differentiated me from a lot of people at GE was that, like, when I went home, I still read about real estate. I still cared about real estate. I was still trying to invest my money in real estate.
Yep.
Whereas a lot of people in commercial real estate who work for CBRE or any of these big firms, like, it's just a job to them.
Yeah.
Right. So if you don't care about real estate, you're probably not watching the show, but if you don't care about real estate, it's going to be a really hard business. And so I think that's what the people who have succeeded and investors who have succeeded is that they just have like a constant desire to keep learning, to keep meeting new people. And that's what separates them, because you can go to a weekend boot camp, you can take a course, you can do all this thing, but the people who really drive past like the 100 no's on every deal, and they really get into closing that first deal, like going from 0 to 1 is it's a huge accomplishment. And now brokers are calling you about your one deal. Like, you got a 32 unit deal in Garland and you're like the king now, right? So, a lot of people are gonna reach out to you. And then, I think we help people sort of go up that curve from 0 to 1 and then really start growing from 1 to Michael Becker, right? So 1 to 20 or 1 to 30, like that incremental piece is where I think a lot of people get stuck too, is they get one deal, they used all their money on that one deal. Now they got to wait for that deal to sell. And that's where I think we help people sort of think about syndication. We think about partnering with other people and sort of growing them. So that's it.
That's great. Yeah, no, I think there's really kind of 3 fields I've seen a lot of people like kind of come out of. I think, you got people that work for maybe like start as an analyst at a brokerage shop and then maybe become a junior broker and come over into the ownership side. I see a lot of people go to private equity firms. So out there placing money in these different deals, they learn the business that way. And the harder way, I think, is the way we did it, which is the banking, because then you get this like conservative mindset because all the people around you are so conservative. So it's kind of hard to, take a little bit of risk, let alone a lot of risk to do some of these deals. So I think that's great advice. So James, I've known James a long time. James is, a great resource. So if you guys are thinking about getting into this business, you're thinking about trying to borrow some money, you want to come into some of the markets that Old Capital really plays in particular in Texas, as you guys probably do 75% of your business in Texas. So if you're coming from California or New York or wherever, wanting to come to Texas, I think James would be a great person to reach out to and talk to. So James, people want to find out more information about you, want to connect with you, maybe give a resource or two on how to learn a little bit more about you and Old Capital.
Yeah, you can go to the website, oldcapitallending.com. You can go to the podcast website, oldcapitalpodcast.com. I'll give my email. That's probably the best way. It's jeng@oldcapitallending.com.
James, definitely appreciate it. So for James Eng, I'm Michael Becker. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.